Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today we're going to get an update on our financial sector. And joining me today is Lee Grimshaw, our portfolio manager responsible for that sector. Welcome, Lee.
Thank you, Michael.
Great to have you on the show. So let's dive into it. So, the financial sector, I always like to first start off from a business perspective, then we'll talk about how markets react. But generally speaking, and we have holdings, our core picks, we have them both north and south of the border. Why don't you give us a feeling from a business perspective, how have our core picks done?
Yeah, the core picks have done well. It's a bit, in a certain sense, it's a bit of a tale of two cities with respect to Canada versus the U.S. The U.S., for the most part, as a banking segment, have kind of held their own from a financial reporting perspective, whereas the Canadian banks, while generally doing okay, were a little bit more muted in terms of their net income at the end of the day because they had a few more provisions for credit losses generally across the board. Not every bank, but for the most part, most of the banks did have that, in fact. And part of the issue is that a few years back, the reserve requirement for credit losses, or the ACL as they call it, was forced to reevaluate the way they value the particular provisions, in that it's a through the cycle provision. So effectively you could have provisions in the credit losses that aren't reflective of an impaired loan, i.e. somebody who's maybe not paying at the moment, and really an expectation as to what the economic future may hold and how that may impact the loan book as a whole. So I guess in that regard, the Canadian banks suffered a little bit more, but did not suffer is probably the wrong word. It just impacted them a little bit more than the U.S. banks. So then from that perspective, the U.S. banks, where they got hit was a little bit more on the deal side, i.e. the Goldman Sachs and Morgan Stanley, because there was generally a bit of a loss of confidence in the marketplace with respect to the tariff issues that are out there. So that's really a bit of a synopsis. But overall, the portfolio did well against the market backdrop.
Nice. And so let's, so that was good from a bank's perspective. Insurance, any views in terms of the insurance companies and how they've done?
The insurance companies have been a great place to hide. So since the onset of the tariff announcements, we've been really coaching our portfolio managers to pivot a little bit to more of the insurance companies. They, as most people can imagine, have been least affected by the tariffs. There's still some indirect view that indirectly they could be impacted just given consumer confidence at the end of the day, but generally speaking, less impacted. And they performed quite well. So both a life insurance company basis, property and casualty, which would be represented the core pick of Berkshire Hathaway, which isn't entirely a pure play P&C company, but it does have a significant amount of the net income derived from that particular segment. And then the brokerage business, which is Arthur J. Gallagher, which is in our pick, and that was sort of the second performing stock amongst the entire finance sector as a whole, and then the best insurance related stock in our portfolio.
Okay, well, that's good. Good to hear. So business is doing reasonably well, and then so from a markets, how are the markets reacting to the sector in general, and then our holdings?
So the market, it's a little bit below what we expected, but it's been holding in there. So overall, I think it was a bit of a break even with respect to the index returns, whereas I think the market for that same period was down a little bit with respect to the S&P 500. And then overall, we had a positive rate of return to the tune of just a little bit under 4%. So we outperformed the market by a nice margin. And generally, we've been on the indexes or slightly ahead of the indexes in the past few quarters. So we think we've got a good set of picks on our core pick list, and they've done relatively well.
Yeah, we were just looking at the numbers, and one thing I always like to stress to clients when I get to meet them and on this podcast, we're not overly fixated on the indices. It's good to know, obviously, seeing what the market is generally doing, and we know that clients may be bombarded with information on the index. But it's good to understand if you think about our QSECT approach, generally how we position it and how it's, the fallout of the approach of investing in quality firms is typically when you have volatility, we tend to outperform. And you notice all the weasel words that I use there because we can't make any guarantees or the like. But that is, generally that is exactly what we see. We go into quality holdings that when you have this uncertainty, we tend to outperform. And again, in the financial sector, we're seeing that with our holdings compared to, as you say, the sector indices. So that's good to see that the approach continues to stay true to our methodology. So good stuff. So let's talk about looking forward. Statistics are coming out just as we're recording this. Canada's trade deficit got significantly worse because of the tariffs and the like. As you look at the financial sector, what are you watching in terms of, how things are going to shake out here and moving forward?
Yeah, very good question, actually. For the Canadian banks, we're very much looking at the employment rate, as that's the main driver of at the end of the day housing defaults. And as people may or may not know, we've got one of the biggest wave of refinancings this year with respect to mortgages, and some of those default metrics are moving upwards. Not super materially, but they are going up, and as is in a very slight manner. So as I think the employment index this morning, which actually came out better than expected, but is still tending to trend up, meaning higher unemployment rates, especially in no surprise areas like Oshawa, Windsor. We're definitely paying attention to those type of metrics. For the U.S., it's maybe a little bit more mixed. The employment rate, they had a good print today with respect to that element. They don't have the same wave of refinancings given that they have much longer duration mortgages, so they don't face the same risk. Mostly where their credit provisions went up in this past quarter was really on the commercial banking side. And there's no surprises there that you're going to have to look at both consumer confidence and trade indexes with respect to the effect of tariffs on the individual counterparts and industries in the United States. The other element that we're paying close attention to is the deal-making activity. So the center of the universe for IPOs and M&A is obviously New York. And so Goldman Sachs and Morgan Stanley, two of our core picks, are materially affected by those types of metrics. So we're paying attention to those type of metrics that might drive that particular type of business. So really, again, a tale of two cities with respect to what's happening in each country, but they are trending similar in a similar fashion.
Okay, thanks, Lake. I can't help anytime we have these discussions and I think of this volatility. And I mean, you have volatility, it's natural, but this one is just also self-inflicted. And it just shakes my head every time we talk about it. You're going to have volatility, but this one is just being caused by an administration, which, anyway, we just have to keep moving forward and stick to our principles and be disciplined about it. Yeah. Lee, thank you so much for this update.
Thank you.
Folks, as always, if you have any questions on what we talked about here, don't hesitate to reach out to your CPA firm's advisor or talk to your TriCert portfolio manager, or don't hesitate to reach out to myself. Take care.